Are real estate investors driving up house prices in the Toronto area? That's the question I'm going to look at today. My name is John Pasalis, president at Realosophy Realty. You can catch all my latest writings on Toronto's housing market at movesmartly.com. If you find this video helpful, please hit the like button and subscribe to stay up to date on all my latest videos. So CIBC came up with a note this month that argued that it's impossible to say that investors are driving up house prices in the GTA. And while their argument is technically valid, the issue regarding investors in the housing market is a little bit more nuanced. So today I'm going to unpack their argument, and we're going to look at some of the important issues to think about when looking at how investors impact the housing market. So CIBC's argument is basically one that economists will often make. So when economists are looking at factors that drive house prices up, they might see, for example, certain areas that have a high number of investors buying homes also have a higher rate of house price appreciation. So one might assume that the relationship looks like this, that the areas that have more investors are causing house prices to appreciate much faster. But we can't jump to that conclusion so quickly because we don't know when we're studying these models, what if there are other factors that are causing house prices in some of these neighborhoods to appreciate much faster? And it's in fact the much rapid higher rate of appreciation in these neighborhoods that are pulling investors into the market. So investors are gravitating to the higher appreciating neighborhoods that are appreciating because of some other factors that we're not even measuring, which would make the relationship kind of look more like this, that the high appreciation that are caused by some of these other factors is actually luring in more investors into the market. So this is basically a very simple statistical argument that they're making. If you can kind of get that, and hopefully you did, you can basically pass an undergraduate econometrics class. But this is basically the key argument CIBC is making, which is a very valid one. It's impossible to prove what's coming first, the investors or the high appreciation. But the bigger issue is, well, what are the other issues that we need to think about when thinking about how investors impact the housing market? In my April report, I argued that the federal government should be putting in policies in place that either make it harder or less lucrative for investors to buy up single-family homes. And largely for a couple of reasons. I mean, number one, we have a housing crisis in Canada. So I feel just principally, if the government's going to do anything, they should be making it harder for investors to jump into the market, making it easier for first-time buyers to get into the market. And this is kind of how we try to bridge this affordability gap. I mean, I think it's by tightening credit on investors and effectively loosening a little bit on home buyers. So just principally, I think that's the right thing to do. But the other has to do with how investors impact the housing market, both on the way up and on the way down, and how they can potentially make the swings in the business cycle far bigger than they otherwise would be. Now, I'm basically going to kind of summarize a great interview based on research from an academic, an economist at MIT named Alp Simsek. I'll add the link to what is a pretty good podcast and interview that he gave where he unpacks these ideas. And at the very core of his argument is this idea that investors and everyday home buyers tend to have very different beliefs about the future appreciation in house prices. And it's these different beliefs that leads to completely different behaviors. So in good times, the investors tend to be significantly more optimistic. So they'll buy investment properties. I mean, even CIBC's report found that when they analyzed the types of investment properties investors were buying today, many of them were actually cash flow negative, where the investors were actually, the rent they were collecting each month wasn't even enough to carry their carrying costs and their debt payments. And the reason a lot of investors in the GTA now will still buy properties that are losing money each month is because they simply assume it's going to be worth much more in the future. So in good times, investors are more eager to bid up prices. They'll spend more than end users. They'll load up more on debt and leverage themselves to buy properties because of this expectation that house prices will keep going up higher tomorrow. So in good times, they actually push house prices up higher than they otherwise would be. Now, more importantly, if we see an adjustment in the housing market and a decline in prices, well, this is where expectations actually flip. And it's in these markets where the investor is actually the pessimist. And they become the pessimist because they tend to be over leveraged and are more vulnerable actually to price declines than an end user is who has just one property. So in a down market, and we've seen this in many down markets, we saw this in the US housing market, and coincidentally, we actually saw it to some extent in the past year in the in the city of Toronto's condo market. Once rents started falling, once condo prices started falling, we did research that found that it was the investors that were more eager to kind of put their units on the market and sell them and exit than actually end users. So the investors were more eager to dump their units and get out of the market than end users. So the reason this is an issue is because if we start to see a decline in house prices in the future, when the market's really dominated by an investor, they have an outsized impact on the way down. And if too many of them start exiting the market very quickly, they can actually kind of cause house prices to fall a lot further than they otherwise would, which effectively makes the decline even worse than it otherwise would be. So this is why, economists like Alp Simsek and others argue that, the role of governments is to try to soften these big swings, and especially on the downside, to mitigate the downside by reducing the effect that investors can have on the housing market when expectations change, when things get worse. Because in Canada right now, and in the GTA specifically, the Bank of Canada has done research where, over 1 in 5 properties are bought by investors. So they're definitely having a significant impact on the housing market. And of course, if many of them are over leveraged, they can have an outsized impact when things start to cool. Now, right now, I think that the biggest risk is not so much investors in the, in the resale market. I think the bigger risk potentially are the optimistic investors that are bidding up pre-construction prices in the GTA. The spread between resale prices and pre-construction prices is quite high. Urbanation, that analyzes pre-construction prices, published a report in the first quarter, and they found that even with the rebound in prices in downtown Toronto, average condo prices right now are selling for about $1,000 a square foot. Pre-construction prices in the same area are selling for about $1,400 a square foot. So that's a significant premium that investors are paying for these condominiums. And the concern, of course, is, there's no concern if prices and rents are rising 10% a year and the market catches up to what these investors have paid, but what if they don't? If investors, the CIBC found today that investors are cash flow negative in a market where average condo prices are $1,000 a square foot and where interest rates are at historic lows, well, what's the cash flow going to look like on these properties that are being bought at $1,400 a square foot and potentially higher interest rates 3 or 4 years down the road once they're completed? And of course, if they're significantly cash flow negative, are people going to want to hold on to these properties, or are they going to be eager to sell them before they even take possession? So again, these are some of the concerns. These are issues that have come up in other markets internationally and sort of downturns. So they're important ones to keep an eye on. That these shifts don't happen overnight. We tend to see them gradually progressing. So there are some red flags. So these are certainly things that we'll be keeping an eye on in the long term. I don't expect any immediate issues with these things, but these are certainly things that I think policymakers should be keeping an eye on over the next couple of years as some of these high-priced pre-construction condos start completing, to see if prices and rents kind of make them a good investment still. Hopefully that all makes sense. If you have any questions, please feel free to post them below or send me an email at askjohn@movesmartly.com.